Hello, my name is Anthony Sicaro, founder and president of Providence Financial and Insurance Services, located in the heart of the San Fernando Valley in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday at 4 o'clock p.m. on AM 870 KRLA The Answer. And I want to take a minute and answer a question that we've been getting over the course of the last week from our clients. And that question is your money safe? And this video is primarily designed for my clients. So if you're a client of mine, thank you for your business. Thank you for your trust in us. And part of my communication here is just to remind you of our strategies, our core values, and answer the question, is your money safe? If you're not a client of ours, then thank you for watching this video. You're certainly welcome to do so. If you have any questions about anything that I say, don't hesitate to contact me or one of my team members. And you can do that by going to providencefinancialinc.com. Is your money safe? The reason that a lot of you have asked me that question is because as of the recording of this video, the stock market has gone down about 6% in the last week and a half. So that begs the natural question, is your money safe? Well, I need to remind you of how you are invested. Because remember, most of you are not invested in the stock market. So when the stock market goes down, you're immune to that. When the stock market goes up, you're not going to participate in that. So you're not invested in the stock market. Why? Because our focus for you is to protect your principal and get you income without ever having to touch your principal while leaving your principal intact. So let me ask you, does the stock market protect your principal? We know the answer to that, right? Certainly there's no guarantees, and not even that there's no guarantees, but things can happen very fast, very volatile. And the older you get in life, and you know that I specialize in working with people that are in the latter half of life, the older you get in life, the more conservative you have to be, okay? Now, if you're younger, then certainly you can have money in the market and you can ride it out and may not be a bad way to go. But the more conservative you need to be as the older you get. So the answer is no. The market does not protect your principal. The other question is, will the market give you income? And again, the answer is no. When you want to get income out of the stock market, the only way to do that is to sell shares. And if you sell shares, you cannibalize your portfolio. And if you live long enough, then you're in real danger of running out of money. And that's the problem with market investments. So if our core value and our core belief and our core goal is to help you protect your principal, but get income that you can live out of, the stock market doesn't accomplish those goals. And that's primarily why you're not invested in the market. So when the market goes down like this, your principal is protected. Your money is safe. And if you want to just watch another video about this, I've talked about the difference between investing for growth, aka stock market and mutual funds, versus investing for income. Right? I go into great detail about that in a different video that's actually called Income versus Growth. So go onto our YouTube channel, watch that video, and we get into more detail about this. Now, just as a side note, for those of you that are watching this, some of you follow me on YouTube. A lot of people already follow us on YouTube. But for those of you that want this information that don't follow us on YouTube, that means you've probably gotten this video through an email that we sent you. And anytime I put out something urgent, we try to send it out in an email. Plus, we do a newsletter the first Tuesday of every month. So we try to get the information to you whether or not you follow us. But if you follow us on YouTube, then YouTube will send you an email that says, hey, there's a new video, go and watch it. And you'll get that instantaneously. Whereas if you wait for us to take that video and embed it in an email and send it to you, it may take a couple days for you to get it. So it doesn't mean you won't get it. It just means it may take a couple days. So I would just encourage you to go actually to YouTube, follow us. You can do that by going to our website, providencefinancialinc.com. In the upper right corner, there is an icon, a YouTube icon. Click on it and click follow. That's it. That's as easy as that is. So a reminder, you're invested for income. You're not invested for growth. While you are following us on YouTube, watch that income versus growth video. Now, if you're invested for growth, then the performance of your portfolio is going to depend on growth-oriented items like stock markets or like mutual funds. So when the market does go up, you'll make money. When the market does go down 6% in this last week, then yes, you're going to wind up losing money. We've had several clients or really individuals that are starting to become clients that have lost a significant amount of money in the last 5 days. How much? Right around 5%. We have a client that's got about $600,000 that, $600,000 10 days ago and $570,000 today. $30,000 less. We have a client with about $2 million in the stock market that is considering or really just decided to become a client that lost about $75,000 over the last 8 trading days. So the reality is the reason that they've lost that money is because they're invested in the stock market. The good news is for you is you're not invested in the stock market. The stock market doesn't generally affect your investments. But then the question is, what does affect your investments? The answer, interest rates. Interest rates will affect income investments more than the stock market. And income investments will react opposite of interest rates. So when interest rates go down, then income investments are actually going to go up. And when interest rates go up, then income investments are generally going to go down. And yet they don't stay in that locked position. There's a constant fluctuation of interest rates, and there's a constant fluctuation of your investments. But that fluctuation doesn't occur over days like the stock market. It doesn't occur over weeks or months like the stock market. That fluctuation tends to occur over a period of years. And the Federal Reserve, for times, will raise interest rates over a period of years, and then they'll lower interest rates, and sometimes they'll lower interest rates over a period of years, but usually they lower rates. Matter of fact, almost all the time, I can't think of an exception, that they will lower rates much, much faster than they will raise rates. Why? Because when the stock market is starting to falter, and the Federal Reserve lowers rates. Well, the whole point of doing that is to make money cheaper to borrow so that people borrow the money and they go out and spend it. And as they spend the money, it's designed to help prop up the economy and prop up a falling stock market. So they tend to lower rates very fast and raise them very slow. And a lot of times they'll raise them over a period of years. And so what's happened is over the last year and a half or so, the Federal Reserve has raised interest rates 7 times. So what that means is that income-producing investments have gone down. They've gone down. How much? Well, a lot of our clients have gone down in the range of 2 to 4%. I think there might be a few on the outer side of 4%, maybe closer to 5%, but really between 2 and 4 is what most of your portfolios have gone down. Why? Because interest rates have gone up. And again, I'm not going to repeat what I've talked about in the income versus growth video, but in the video I talk about that. Please go watch that video so that you can be refreshed as to why it works like that. The situation with you, though, and the answer to your question, though, is that your money is safe. This is not unexpected. As a matter of fact, with almost all of you, almost everyone that's my client, when we took you on board, we had this conversation. We talked about the fact that, a year ago and 2 years ago and even 3 or 4 years ago, we know that interest rates were headed up. And therefore, we know that your portfolios are gonna head down. But that's okay. Why? Because your income stays the same. If you can live off your income and your dividends and your interest, and you don't have to sell shares to get your income, then how much does this short-term fluctuation affect you? The answer is it doesn't affect you. And that's the key ingredient to investing for income, is that your income stays the same even if your portfolio goes down. As a matter of fact, if the values of your investments go down, for those of you that are not actually spending your income, for those of you that are reinvesting your income, then guess what? Having a lower price means that you actually get a better deal when we reinvest your dividends and interest. So it's not a bad thing at all. It's just the way that income portfolios work. Now, let's fast forward. You know that I've been a bear on the stock market for a long time, and really for 3 or 4 years. And I'm not going to take time to go over why that is. Again, we've got YouTube videos on this. If you go back to my YouTube, I've done 3 or 4 videos this year about why I think there's problems ahead in the market. Maybe I'll do another one here soon. But the reality is you've got plenty of information to go back and watch and review to learn why I think there's going to be problems. But if we boil it down to its simplicity, you buy low, you sell high. The market is in the longest bull cycle that this country has ever seen. Starting in March 9th of 2009 and just August of 2018, it's now become the longest bull market that this country has ever seen. Is it going to last forever? Does anything last forever? We know the answer to that. We've had 2 times in the last 18 years of markets crash by 50% or more. It's not going to last forever. So how does that affect you? What that means for you is this. That means that when the stock market starts to falter, as maybe it has, when it starts to falter and it starts to go down and we start to have some of the problems that we're expecting, guess what's going to happen to interest rates? Interest rates are going to go back down. And guess what's going to happen to your portfolios? Your portfolios are going to come back up. Going to come back up because interest rates have gone down. And so it's very expected. But interest rates go up slow. Interest rates have been raised over the last year and a half. Portfolios tend to generally come down slow. It's totally expected. Now, for those of you that have only been clients of ours for maybe less than a year, or maybe certainly less than 2 years, then you're going to see the impact of this more than those of you that have been clients of mine for 5 or 6 or 7 years or more. Why? Because if you've been a client of ours for 5 or 10 years, then you've gotten interest along the way, 4 or 5%. You've earned that. If you've earned 5% a year for 5 years, that's 25% on your money over time. So if the market goes down 2, 3, 4%, it's not a big deal. I mean, you're still well ahead, and you know the game. And we've had this conversation a lot, and you remember what you signed up for because we had this conversation, so you understand the program. But if you've only been with me for a year and you've given us some money, well, you haven't even earned a full year's worth of interest yet. So if your portfolio is down by 2 or 3 or 4%, you haven't even earned that interest yet. Then it can be disheartening. It can be you can look at that portfolio and wonder if you made a right decision. And if you're looking to protect your principal and invest for income, then the answer is absolutely. Absolutely, that decision was right. And you think about it. If you're earning 5% a year on your portfolio, and the market or your portfolio drops by 5%, then guess what? At the end of the year, it's going to look like you didn't make any money. It's very easy to say, "What's Anthony doing to me?" Okay? But that's the way that it works. Now, when the market does come down and your portfolios go up by 5%, and you earn 5% on your portfolio, well then guess what? That year it's going to look like you made 10%. The reality is you don't want to focus on the share price. If you're invested for growth in the stock market, then the share price is everything. There's one number you look at, the bottom line, and the bottom line tells you how good or how bad you did that month. When you're invested for income, it's not about the bottom line. It's about the amount of income that you get every single year coming in. Every single year. That income, and how much can you take out of your portfolio and spend, how much and how can you protect your principal. That's what we have helped you do. So I just wanted to answer the question, is your money safe? The answer is absolutely. Is your principal going to fluctuate along the way? Absolutely. We know that. We've known for the last couple of years that rates are probably going to go up. We've known for the last couple of years that your portfolio is going to come down. And by the way, it doesn't go down indefinitely. It's just not the way that income producing portfolios work. Someone asked me the question, well, if it keeps going down, then eventually I'm going to lose everything. No, that's not how the income portfolios work. A lot of times what happens is they'll go down, then the market starts to have some problems like this, and we're down 6% in a week and a half. And what happens is it's caused some share of people to jolt. It jolted them. Some people look at it as a buying opportunity, but some people say, wow, I just lost $50,000. Maybe I need to become a little more safer. So it actually causes people to get them a little more safe with their portfolios, or at least to take a second look to see if what they're doing is right. And a lot of these people are going to take some of the chips off the table. Well, when they take the chips off the table, what do they buy? They buy the investments you have. They buy the income producing investments, the investments that are designed to protect your principal and give you that interest and dividends. So when they buy those investments, your investments, it creates a demand for your investments. So even though interest rates as a whole have come down, little market fluctuations and hiccups like this, it'll create a demand for your investments, and a lot of times they'll come back up a little bit. So you're gonna see a constant fluctuation. Now, is this stock market volatility that we've had in the last week and a half, is this the start of something bigger? I don't know. No one knows. We know that at some point in time we have to have, the market's going to have major problems. I don't know if this is a start, but I will put out videos as I think they're necessary. If you follow us on YouTube, then you'll get my thoughts along the way. I hope I answered the question, is your money safe? If not, if you want to have a conversation about this more, feel free to contact us. If you're a client of ours, you're open to have a review anytime you want. All you need to do is call us. And again, if you're not a client of ours and some of what we've talked about has intrigued you, feel free to look us up on our website, providencefinancialinc.com. Thank you for watching.